Hello friends, welcome to EPG Pathshala. I am Dr. Manish Shrestha, working as Assistant Professor at Haryana School of Business, GJ University of Science and Technology, Hisar. Today, we are going to discuss about the topic stock-based compensation. Before starting the discussion, let's have a look at the contents. The discussion will start with the introduction of the topic, followed by meaning of stock-based compensation, their kinds, methods to measure, compensation activities involved, guidelines of SEBI, and demerits of stock-based compensation. The discussion will end with a summary. By the end of this module, students will be able to understand the concept of stock-based compensation, identify different kinds of stock-based compensation, and identify different activities involved in stock-based compensation. The history of economic progress had long back laid the foundation of separation of ownership and management. Due to formation of companies, huge pool of resources is created that creates synergy of fantastic development at all fronts, whether economic or social. Pooling creates greater efficiency, enlargement in scale of production, transfer risk to diversified stakeholders. In spite of huge amount of benefits, separation of management and ownership involves various types of costs. Separation gives rise to costs because the priorities of the principal, that is shareholder, and the agents, that is employee, differ. Due to this reason, employees may sometimes act in a manner that is not very beneficial to the stakeholder. The use of stock-based compensation is actually looked at one of the best ways of aligning the interest of the shareholders and the employees. In the past few years, stock options have enlarged a significant component of compensation for executives and employees. Actually, stock options give the employees the right to purchase shares in future at a specified price. This means that higher value of the company is associated with higher value of stock options. This in turn implies that the financial goals of employees are directly related to those of shareholders. Studies and surveys have proved that stock options are increasingly being used at all levels of organizations. It is also believed that stock options are used as a way to attract and retain employees, especially executives. Stock options seem to be great motivator in organizations where there may be cash crunch. So using this method, the organization can save some cash also. Stock option plan plays an important role in compensation package which is offered to the equity participants. Stock option means right to purchase a definite number of shares of a company's stock at a definite price for a definite period of time. Companies normally grant fixed option where the exercise price is fixed and the number of shares can be determined at the grant rate. The exercise price is normally set equal to the equal market price of the underlying stock at the grant date and remains fixed till the life of the option, although there are few exceptions to it. Employee stock options provide a vesting period of several years before which the stock option cannot be altered. Vesting period is a time period under which employees become eligible to actually own the stock. Stock option is used as a long-term compensation method by the companies. Options are frequently granted to the executives and other employees as an alternative to raise the base compensation. Few of the reasons for using stock options are: options help companies to cope up with the labor markets. Options stimulate job creation in knowledge-related industries. These are tax efficient way to pay employees. These offers an opportunity to reduce employees' base compensation. This balances the huge gap between executive and other employees. Employees develop interest in the organizational activities just as shareholders have once they have the opportunities to opt for options. It is scattered through the management and professional ranks. Fraction of the reason for the increase in stock options has been the rigid labor market and the explosion in high technology job creation and economic growth. One of the basic goals that is applied on stock options is the observation that a company with a broader stock-based compensation plan may face a significant raise in its shareholder value over a certain period of time. A controversy may arise if this company is compared with its industrial growth, because it is difficult to tell whether employees did well or shareholders did well, which may prove to be a hose if the company actually did worse than the rest of the industry group. The term stock-based compensation is a wide term that embraces the compensation of an employee in stocks, stock options, stock appreciation rights, and other stock-related awards. Stock-based compensation can be classified into two categories, that is, restricted stock plans. The most traditional form of stock award was grant of stock at the completion of a specified period of satisfactory service. There may be a clause that a specified number of restricted stocks are granted on achievement of some performance goal or attainment of a specified level of targets. A point worth noting is that grant of stock does not mean ownership of shares at a later date. The share units accrue dividends during the deferred period that are credited to the account of the employee either as cash or as additional stock. This plan is having certain benefits. Incentive plans can be altered as and when demanded. There is no dilution of the issued share capital as no share is transferred on exercise of the option. Work efforts is aligned to organizational growth and progress. Minimum or very low administration cost is involved. Organizations enjoy the tax rebate benefits. Despite a few advantages, it also suffers from some demerits, like cash flow cost is also included in this plan, and bonus in the hands of employees is also chargeable to income tax. The second plan is Employee Stock Purchase Plan. It is a stock purchase warrant issued by a company to an employee in exchange for his services. This plan allows purchase of company stock at regular intervals. Sometimes, in place of compensation, the employee gets an option to purchase the stocks of the company. Employee stock options are means of linking compensation to the stock price, which is a measure of company performance, and are means of minimizing the agency problem. Generally, these purchases adjusted against reductions in employees' compensation. In such deals, brokerage fee is nil. Often, the plan supports purchase to be made at a discount from the fair market value of the stock. Certain advantages of this plan is ownership remains in the hand of company through instant stock purchase. Motivation for improving individual, group and organizational performance. And deferred compensation normally yield higher return. Apart from merits, it is having certain demerits. Share capital of the company increases. Cash flows over time, and stock market fluctuation and risk play significant role. There are broadly two methods to measure stock-based compensation: the intrinsic value method and the fair value method. The intrinsic value method is used to measure compensation expenses in excess if any of the quoted price of the stock at the measurement date over the amount of which the employee must pay to acquire the stocks. If the exercise price of the stock is equal to or greater than the market price of the stock at a grant date, then no intrinsic value and no compensation expenses would be recorded in the income statement. Factors that may influence the price of an option are price of underlying assets, striking price of option, remaining time till maturity date, expected dividend on underlying stock, risk-free interest rate for the expected life of the option. The fair value method. This method is used to measure the compensation cost on the grant date of the option, which is based on the estimated fair value of the option, which is determined by using option pricing model. Stock options normally determined as a fair value at grant date because of time. Normally, many years during which options was exercisable and the amount was posted as an expense in the income statement of the organization. Stock-based compensation involves certain activities such as granting activities, that includes decisions related to number of grants, grant dates, lock-in period and date on which stock options will be provided by the compensation committee and board of directors. Secondly, administration activities. It includes reconciling employees' data with the given information, ensuring booking in financial statements of the organization data on forfeiture, stock exercise patterns and deciding methods for calculations. The third activity is calculating activity. It helps in rationalizing the assumptions which are used in calculation and forfeiture. It involves the documenting all such calculation and forfeiture assumptions. And the last one is reporting activities. It includes reporting stock compensation details in balance sheets of the organization for ensuring appropriate income tax reporting. Maintaining proper records of internal and statutory audit is to ensure that it complies with SEBI guidelines. Employee Stock Option Scheme and Employee Stock Purchase Scheme Guidelines 1999 of Securities and Exchange Board of India provide certain guidelines. Under the SEBI guidelines, employee compensation means the total cost incurred by the company towards employee compensation, including basic salary, dearness allowance, other allowances, bonuses and commission, including the value of all perquisites provided, but does not include the fair value of the option granted under an employee stock option scheme and the discount at which shares are issued under an employee stock purchase. Employee stock option means the option given to the whole-time directors, officers or employees of a company which gives such directors, officers or employees the benefit or right to purchase or subscribe at a future date the securities offered by the company at a predetermined price. Compensation Committee. A compensation committee refers to a committee which consists of a majority of independent directors. The compensation committee constructs the detailed terms and conditions for the ESOS. The quantum of option to be allowed under ESOS per employee, situations under which option is invested in employees may help lapse in case of termination of employment of misconduct. It includes time period within which the employee shall exercise the vested options in the event of termination or resignation of an employee. An employment has the right to exercise all the options vested in him at one time or at different point of times within the exercise period. The compensation committee should frame suitable policies and systems to make sure that there is no violation of Securities and Exchange Board of India Insider Trading Regulations 1992 and Securities and Exchange Board of India Prohibition of Fraudulent and Unfair Trade Practices related to Securities Market Regulations 1995 by any employee. Eligibility to participate in ESOS. An employee is eligible to participate in ESOS of the organization. If an employee is a promoter or comes under the promoters group, is not eligible to participate in ESOS. And if a director directly or indirectly holds more than 10% of the outstanding equity shares of the company, is not eligible to participate in ESOS. Shareholder approval. Employee stock option scheme can't be offered to the employees unless and until shareholders of the organization approves the scheme in general meeting by passing a special resolution. The resolution proposal passed in general meeting for such options should contain the information such as total number of options to be granted, identification of classes of employees who have right to participate in the scheme, need of vesting and period of vesting, maximum period within which the options shall be vested, exercise price or pricing formula, exercise period and process of exercise, maximum number of options to be issued per employee, the appraisal process for determining the eligibility of employees to the ESOS. Variation of terms of ESOS. Organizations can't change the terms of ESOS at any cost, which may be detrimental to the interest of the employees. Lock-in period and rights. There should be a maximum time gap of 1 year between the grant of options and vesting of options. The organization have the freedom to specify the lock-in period for the shares issued pursuant to exercise of option. Employees don't have right to receive any dividend or to vote or to enjoy the benefits of a shareholder in respect to option granted to him till the shares are issued on exercise of option. Consequences of failure to exercise option. If any amount payable by the employee at the time of grant of option may be forfeited by the company if the option is not exercised by the employee within the exercise period. Amount can be refunded to the employee if the option is not vested due to non-fulfillment of condition related to vesting of option as per the ESOS. Non-transferability of option. Employees can't transfer their option to any other person. Only those employees are entitled to exercise the option to which option is granted, and no other person can do so. The option granted to the employee while in employment, all the option granted to him till the date of his death shall be transferred to his legal heirs or nominees. If the employee becomes incapable while in employment, all the option provided to him as on date of permanent incapacitation shall vest in him on that day. In case of resignation of the employees, all options not vested as on that day shall expire. Disclosure in the Directors' Report. The Board of Directors disclose either in the Directors' Report or in the annexure to the Directors' Report of the ESOS the following information. The pricing formula: options granted, options vested, options exercised, the total number of shares arising as a result of exercise of option, option lapsed, variation of terms of options, money realized by exercise of options, total number of options in force. Certificate from auditors. The Board of Directors place an auditor certificate before the shareholders in the annual general meeting that ESOS has been implemented in accordance with the guidelines and also in turn with resolution of the company. A well-designed stock-based compensation plan is the best way to show organizational performance, but stock-based compensation has various criticisms like fluctuations in stock market. Value of stock varies at different point of time due to fluctuations in stock market and which is beyond the control of the employees of the companies. In a bullish market, the value of stock raised significantly with the rise in income of the employees, whereas in bearish market, the income of employees through stocks may be significantly decreased. Cost of option. Most of the time, employees don't want to pay the cost which is close to the full cost of their option. Therefore, it is inefficient substitute for cash compensation and a poor way to attract employees. Attrition. If the stock prices decrease below the exercise prices, then the employees will leave their current companies and join the offer of the competitors' new compensation package. Not universally applicable. Stock-based compensation cannot be implemented for the employees working in government services or non-stock companies. Deep pockets. It needs to acquire sufficient funds to exercise the stock option by the employees. Relatively unattractive. It will not attract any employee with high cash needs than different financial needs. It provides an incentive for managers so that unrealistic expectations can be built and that may raise the stock price even if the process of creating the unrealistic expectations irreparably harms the company. And finally, enhanced equity based. It raises the capital base of the organization which will lead to fall in stock prices. If the organization issues the large number of stock to the employees, then there will be a significant fall in the stock prices. As stock prices falls, not only employee stock-based income will fall, but return on investment for shareholders will also fall. To summarize the discussion, stock option plan plays an important role in compensation package which is offered to the equity participants. Stock option means a right to purchase a definite number of shares of a company's stock at a definite price for a definite period of time. Companies normally grant fixed option where the exercise price is fixed and the number of shares can be determined at the grant date. The exercise price is normally set equal to the market price of the underlying stock at the grant date and remains fixed till the life of the option, although there are few exceptions to it. The term stock-based compensation is a wide term that embraces the compensation of an employee in stocks, stock options, stock appreciation rights, and other stock-related awards. Restricted stock plan, it is the most traditional form of stock award which grants of stock at the completion of a specified period of satisfactory service. There may be a clause that a specified number of restricted stocks are granted on achievement of some performance goal or attainment of a specified level of targets. A point worth noting is that grant of stock does not mean ownership of shares at a later date. The share unit accrue dividends during the deferred period that are credited to the account of the employee either as cash or as additional stock. Employee stock option purchase plan is an employee stock purchase plan, that is a stock purchase warrant issued by a company to an employee in exchange for his services. This plan allows purchase of company stock at regular intervals. Sometimes, in place of compensating the employee with cash, the employee gets an option to purchase the stocks of the company. Employee stock option are a means of linking compensation to the stock price, which is measure of company performance, and are a means of minimizing the agency problem. Generally, these purchases adjusted against deductions in employees' compensation. In such deals, brokerage fee is nil. Often, the plan supports purchase to be made at a discount from the fair market value of the stock. Happy learning!